4, financial risk, they're totally worth taking.
Brian, I am excited about this because all the time we talk to people about risk assessment and how do I de-risk my life, de-risk my portfolio, de-risk my financial situation. But today, we're going to kind of flip the script. We're going to talk about some risks that may indeed actually be worth you taking.
And look, we're not talking about NFTs. We're not talking about cryptos. We didn't get caught up in all that. These are actually true things that you can take a risk on and get explosive rates of return over the long term if done the right way. And guess what? We're going to share that with you today.
So let's jump in and talk about the first one. This first one may seem counterintuitive, but in fact, it is risky, and it is investing in your education, adding to your knowledge base in order to improve a skill set or learn a new skill set. And people are like, I don't understand. I went to school. How is this risky? Why on earth could this be considered a risky thing?
I mean, I'm a huge advocate for education. I still think that this is the ladder that gave me the leg up. Mm-hmm. So, but it is risky these days because guess what? Number one, Bo, it's gotten expensive.
That's right. It can be incredibly costly when you think about what an average 4-year costs. If you look at the average cost of an in-state degree right now, it's $26,000 per year. So just doing like real simple math, that's like over $100,000 over the course of 4 years.
Well, it goes even further than that. If we're going to spend $100,000 on something, $104,000 specifically, that actually is an opportunity cost. That's an incremental decision that you have chosen to put that money towards your education, whereas it could have been invested. Mm-hmm. And so we were like, hey, let's flip the script on this and say, what would that money actually potentially turn into? And guess what, guys? $100,000 education is potentially foregoing $10 million at retirement.
Yeah, so whether you paid for that or whether your parents paid for that, that was money that could have been working, that could have been doing something pretty stinking important. That actually leads to the second idea around education, is that most people can't pay for this up front. They have to actually borrow money to do so.
Yeah, this is not shocking because a lot of you resemble this. As we have found from our research, is that the typical undergraduate graduates with a student loan balance right around $33,500.
And I think this is an even more frightening statistic, that 39% of undergraduate student loan borrowers don't actually graduate with any degree at all. That means 4 out of 10 folks go and accumulate and rack up student loan debt and don't actually walk away with the degree. So I would argue in terms of ROI investment, they are not getting a solid ROI on that investment.
Yeah, and then if you think about the fact that there's actually a significant cost in your time. I mean, there is definitely a value in what your time is worth, because not only did you go to school, that's time you could have been working. Why do we pick on doctors? I mean, everybody is always jealous of how much money doctors make, but I look at it with a little bit of a contrarian standpoint. Is I'm like, you realize most doctors don't even get to kind of start their career until they're like 30. All their peers started investing at 22.
That's
so
right.
It's 8 years it's been foregone. So time is money. Don't overlook that risk.
And so the question becomes, okay, well, then why do people do it? If it's so risky, why do you do it? Well, it's pretty straightforward. You either go to college or advance your education to learn a new skill set, or maybe to improve a current skill set you have. But at the end of the day, ultimately, the reason that most of us go to university, the reason that most of us advance our educations, is so that we can make more money, is so that we can actually increase our income through time. So the question becomes, is it worth it? Is the ROI there?
Well, we started off this section, we said, look, we did an incremental decision, matrix decision, where the opportunity cost of the $100,000 it costs to go to college could potentially be costing yourself $10 million at retirement. Now, a lot of people will be like, why would y'all do that? Because that kind of takes the heart of education out. No. I think all it does, is if we wanted to boil it down to a math equation, is what do you have to make per year to offset that of additional earning potential? And we did the math for you. Don't worry. We did the math, and here's what we figured out. You need to invest approximately $1,220 a month, making around 10% at age 22 to offset. If you expanded that out, multiplied it by 12, that essentially means you need to make $15,000 more than if you didn't go to college. So that seems reasonable.
So if you can get a job that pays you enough extra that you could invest about $15,000 more per year, starting from the time you graduate until retirement, then the ROI is pretty much there. Then you can justify the cost if you've worked out that mathematics.
Now, look, I know a lot of you out there, because when we do simplified big decision things like this and try to boil it down to common denominators, a lot of you go, man, right out of school, you don't make $15,000 more per year.
Sure.
That's true. I'm going to concede that point. But I will tell you, someone who come out with like an accounting degree, yes, my starting salary was very low, but if you look at the earning potential over my career, that major more than paid for itself, and education was a good value.
But you just said something so great right there. You said, Brian, I went to school to get an accounting degree, and when I left school, I went into the accounting field. I actually used my degree. Well, what's really, really interesting is only 27% of college graduates work in a field even related to their major. So if you're thinking about getting an ROI on the degree that you pursue, if you actually want that to pay for itself to justify the cost, you probably need to be going into a vocation that is aligned with the degree that you got. But unfortunately, a lot of folks are not doing that.
So this is going to be valuable then. So if that's the risk, if we know that the lion's share, I mean, that's 3/4 of the people out there are doing this wrong, how do we do education the right way?
So the first thing that you need to do is make sure that your college degree is worth it. When you go to college, make sure that the degree you are pursuing could actually pay off in the way that we're describing. If you're just going to try to find something that you enjoy and you think will be interesting, you think will be fun, that may not have the economic impact on your financial life that it should have in order to justify the cost that college has.
Now, I thought this was interesting. The content team actually put together a list of the best college majors and the worst college majors. And of course, it looks like the first two are both engineering positions.
Second two are both in computers and design
And then what's that number 5, Bo? I can barely read that.
Oh, my eyes are kind of good. Does that say public accounting? Oh my
what
goodness.
do you know?
Public accounting.
Accountants made the list as best college majors. So engineering, accounting, these are obviously skill sets that have a lot of market value. So I would tell you, college is a good investment. Now, let's go flip the script and look at the other column, worst college majors. But what do we have here?
Now, this isn't bad college majors in terms of like, don't do this. It's just in terms of ROI. So if you're going to pursue one of these majors, you really want to focus on cost. What are you spending to get that so that you can make sure you overcome that? But the worst college majors, number 1, family and consumer sciences. Number 2, general social sciences. Number 3, performing arts. Number 4, social services. And number 5, anthropology. Again, we're not saying that these are bad majors or bad vocations or things that you should not pursue, but if you do pursue them, you need to go into it with eyes wide open. And probably this is not something you should spend a fortune on to attain that degree if it's not going to be paid off in the years working in that field.
I think a good segue is to think about if you are looking at these majors that unfortunately made the column of worst majors. It's not that, because a lot of these things, if you know that you're the top 5% of a skill set and you want to pursue, there's no doubt performing artist. I mean, I don't know if Ryan Reynolds got a degree in the performing arts,
but he's done okay with it.
But he definitely is a top performer and makes a great, wage.
Make a living,
he makes a lot of money doing that. So you can, all these different majors, you can make a great living, but you probably should put some guardrails for yourself. I don't want your college loans to exceed what the first year expected salary is. If you can follow that guardrail, more than likely you won't get yourself in a bad situation.
And what's great is it's not difficult research to do. It's very easy to go search, hey, what does this vocation pay? Or what's the average salary for someone in the social services in this geography? It's not incredibly difficult to figure that out. So once you have that number, try to keep your student loans below that and know what options exist beyond or instead of college. Just because someone told you, hey, you have to go to college, you have to get a 4-year degree in order to move up in this world, that may not be the case. And maybe now, more than ever, that may not be the case.
Well, I even think, because if we were fine-tuning this about colleges and how do you do college right, a lot of people overlook the community college for your first 2 years.
That's
I mean,
great.
there is a great education hack right there. But then let's just move away from college altogether. There are actually a number of high-paying jobs that don't even require a college degree.
Look at this. This is data from the U.S. Bureau of Labor Statistics. Number 1 on the list of vocations that do not require a college degree, Air traffic controller, median salary about $123,000. Then obviously we have nuclear power operator, transportation manager, police supervisor, commercial pilot, power plant dispatcher, so on and so on down the list. And these salary ranges these median salaries range from $80,000 to $123,000 a year. That is a lot of money. So if you don't think that you want to be an accountant, you don't want to go into public accounting, but perhaps you want to be a commercial pilot, or perhaps you want to be an air traffic controller, it may make more sense for you to not go to college and begin working towards this median salary in these vocations.
Oh, I can't unsee it now that you guys, in show prep, they let me know that this is what the slide that affectionately became known as the Homer Simpson.
There are a lot of nuclear options.
Nuclear power reactor, power plant dispatcher, radiation,
therapist, power plant operator, lots of radiation,
a lot of Homer
and nuclear
Simpson overlap.
stuff.
So there's a Simpson Easter egg in there. Also, but moving on and pulling it back on point, is that there are definitely some certifications and other things you can do that don't require full college degrees. They can obviously have a lot of value out there. And then I want to kind of close it out with the last point here. Be curious, be a lifetime and a lifelong learner. If you can have that mindset and have that curiosity for life, I think there's a lot that you can continue to learn and add value that has a lot of marketplace reward as well.
So, Brian, we talked about how going to get an education or advancing your education can be a risky endeavor, but it can pay off. The second one that we're going to mention, I think, falls into that same camp, because this can be a wonderfully, amazingly rewarding endeavor, but it does not come without risk. It can be aggressive, and that is starting a business, leaning into entrepreneurship, building something of your own.
Well, don't you think some of the sizzle of being an entrepreneur is the risk of it?
Oh, yeah.
Because
for
I
sure.
think that it is known out there in the public sphere that, you know, people who start a business, they potentially could make a lot more money, but there's a high failure rate. So it is definitely risky. And we even have some stats that show this. 22% of brand new businesses fail in the first year.
I mean, that's almost 1 out of 4 if you think about it. Like, that's 1 out of 4
Well, it's
businesses
worse
don't
than
make it
that.
past.
Close to 7 out of 10. So 66% fail in the first 10 years. And I even thought it was interesting. We found this stat that only 9% of small businesses make over $1 million annually. So maybe that sizzle that I was talking about isn't as large as most people think, because it's not even something that happens quickly. I think most people would be shocked to find out if you start a business, you better plan that it's not going to be profitable for 2 to 3 years. It takes a while to catch traction.
And that was your experience, right? When you started, it wasn't something that out of the gate you hung the shingle and all of a sudden money started flowing in. So if it is risky in those ways, why do people do it? Well, the first one you already hit, Brian. You said, hey, a lot of people start a business because they want more freedom, more flexibility, more control over their time. Would you say that was true of you when you set out on your entrepreneurial journey?
Oh, yeah. I mean, you guys, I'm accidental. Entrepreneur is not the right word. It's just I had a life-changing, I always say the clarity of trauma. My father passed away. I didn't like that I was leaving the house before the sun came up, coming home after the sun went down, and I fast forward, thought about myself, and I was like, there's no way I'm going to be able to replicate or benchmark and do as good of a job as my father did living this life. So my why was just disconnected from the life I was living. So yes, I started my first company so I could live life on my terms, aka freedom. And then I also wanted to make an investment in my family and the community, and I needed the flexibility to make that happen. So that was the dream.
So not only could you control your time, but also when you think about entrepreneurship and small business owners and even large business owners, there is the potential to make a lot more money, right? You're no longer you are now the boss. You're no longer depending on someone else to give you your pay raises, someone else to give you your bonuses. You get to be in the driver's seat. But just because that potential is there does not mean that it's a certainty, right?
Yeah, I think that if this is your why, you need to be careful because it's not assured. I mean, this is the biggest thing I took away is that there's a lot of opportunity costs when you start an endeavor. Because realize it's 2 to 3 years just to catch your traction. It also takes maybe a year or two of preparation where you're going to be saving up lots of cash and bridge money to get there. So there's just a lot going on there. And then when you actually dive into the statistics, the actual average small business owner only makes around $62,000 a year. So that's like I said, the sizzle is there, and there is definitely. I think that I love that we work with a lot of very successful small business owners, but it is not the given. It is not the rule for everyone. It's kind of the exception.
That's right. So let's talk about how you're going to do it right. If you are going to pursue an entrepreneurial endeavor, how do you do that? Well, the number one thing that we think probably is the most important is to make sure that you have a bridge account. Make sure you have money in the bank that can bridge you through those difficult times, because your very first customer might not show up day one. Your very first client might not sign up day one. So you want to make sure that you plan and plan and plan and plan so that you have resources to keep your life out of the ditch. Because just because you go out on your own doesn't mean that you're not going to have to pay utility bills. You're not going to have to cover the mortgage. You're not going to have to cover groceries. All the bills are going to show up even when your steady 9-to-5 income goes away.
Well, I think this is why most of them fail, actually, is because it's not that the passion isn't there. It's not that the talent might not even be there. It's the lack of preparation to have the bridge account to get you through that hard 3-year period that you're trying to get clients or get your product out to market. It takes time, and a lot of people just get so excited that they skip the step, and that gets them in trouble. So don't just make sure you have the money, the cash, to get you through that bridge period. And Bo, that also leads to the next thing, because I think people, that's where they should start, is the bridge account. But they start at step 2, which is, hey, what do I have a passion for? What are my talents? And you do need to stress test. Am I the top 5% of whatever I think I'm trying to do? Because that's something, if you're not honest with yourself, you might get yourself in a tough situation.
Yeah, I've got so many friends that fall into this camp. I want to be a business owner. I want to start a business. Okay, what are you going to do? Oh, I don't know. I just want to be a business owner. I'm like, oh, if you're maybe you ought to start with what unique skill do I have that the world needs that I can lean into, and not, I want to be the boss and I want to work 4 days a week and I want to make $1 gazillion. You have to know that you actually have a value that the marketplace will compensate you for. And if you've not figured that out, I worry that you're just landing on a dream and not actually landing on a plan.
Well, and here's something. Let's give you an exercise to actually put pen to paper or to actually start creating the plan. As we always say, put on your 3D glasses so you do this the right way. And here's what I'm talking about when I say 3D glasses. I want you to look at this scenario, the goal of what you're trying to create, through 3 different scenarios, and I want you to plan for each one of them. I'm talking about actually do a 5 to 7 year cash flow plan so you make sure you have your bridge account as well as your plan for how this happens. And here's the first one, your dream plan.
This is the fun one. Yeah, this is the easy one.
It's easy. Everybody wants to think about this is the sizzle of, oh my gosh, we're going to be rich. That's the dream. Then next, I want you to be honest with yourself. This is the down to earth plan. This is what you think is going to happen. Base that. But then, of course, and don't skip this step. This is the unfun one. Has a fun name, but it's the unfun step. The doo-doo plan. Right. This is when, oh my goodness, it's gone horribly wrong. How do I recover when this thing goes sideways really quick?
Failing to plan is planning to fail. And then we have found the most successful entrepreneurs are the ones who can plan through the failure, meaning they see where the risks are. They understand what the doo-doo plan looks like, and they have contingencies in place that even if it goes this way, I know I'm going to be okay. I know I'm going to be able to make it through that. If you don't do that step and things start to get difficult, they start to turn out, you're going to wake up and find that you were lost, wandering around this thing that you thought was going to be so wonderful. Don't find yourself there. Before you take on this very risky endeavor, make sure you've measured twice, cut once before you jump in head first.
That's great. Let's talk about another one. We've gone through the small education, investing in yourself. We've talked about entrepreneurship. Now let's talk about real estate.
Yeah, this is another one. Again, this is a financial risk that can be very risky, but it can be very profitable. There are wonderful pieces and parts to real estate, but I worry. So much of social media, so much of the financial media, so much of the information out there only shows you the brochure. They only tell you academically why real estate is a no-brainer, you should do it, it makes all the sense in the world, without telling you the other side. Why is it risky, and what are the things that you ought to be nervous about if you are going to get into real estate investing?
Well, I mean, I think people, and you saw this in the Great Recession, back from 2008 all the way out to 2012, there was this period where, but right before the collapse, people thought, well, they're not making more real
God's
estate.
not making more land.
Unless you live by a
Finite
volcano,
resource.
it's just not popping up out of the water. So how could this ever go wrong? But the reality is, real estate doesn't always go up. We've learned that lesson. Look at what the median home prices have been in the United States for the last 23 years.
It's wild. If you look from 2020 to 2023, it was a median home price change of 26.5%. Or you can look at the annualized change from the year 2000 to 2023, it's 4.1%. So on the surface, it looks like, oh, the market goes up, real estate makes money, it's great. But that's not always the case. If you think about the Great Recession, what we saw happen in 2008, 2009, it was a drastic and devastating drop in real estate prices. And we've seen that same thing happen since 2021. We've seen real estate prices drop over the last couple of years. So it is not always rainbow and butterflies when it comes to real estate investing.
Yeah, I think when I look at this chart, the big thing I noticed, just like I said earlier, is 2008 all the way to 2012. You look at this chart and you go, wow, not only do you have to worry about potentially it could go down, but it just sits flat for a period. That's why we always talk about U-shaped recoveries. Look at also 2018. I mean, 2018 all the way through 2020, the market is completely sideways. Yep. Those are the problems. It's hidden within the numbers because home pops happen in periods. You can kind of see it here where all of a sudden the market runs up. Pay attention to that because it might be hidden within the data points that this is riskier and that you just might be expecting things that aren't always going to happen in real estate.
Another thing that happens is there may be factors outside of your control that can impact how viable this is as an investment opportunity. A really great example is the end of Airbnb in New York. If you were someone who was going to be a real estate investor and you started buying up properties to do short-term rentals inside of New York, you got a rude awakening when the rules changed on you, when there were things outside of your control that systemically changed that no longer allow you to do the thing that you were planning on doing. Well, we know that these things happen. This would be one of those do plan things you should play out that we've seen play out practically. So if you find yourself overextended here, I think you're going to get yourself in some trouble.
Well, Airbnb is an easy one to sensationalize because it's all over the press right now. But I will tell you, this happens all the time also in communities. Like, think about college towns. We've had this run up in real estate values that I think a lot of naive investors will think, well, hey, I'll go buy a house. I'll rent it out to 4, 5, 6 different college students. They can split it up, share the cost, and I'm going to make a ton of money off this because I'm going to have other people paying for my rent. And then all of a sudden you find out because a neighbor reports it, the zoning doesn't allow that many unrelated people to live together. You need to be very aware. There are a lot of things that happen in real estate that are completely outside of your control. So just be careful.
So I think that we've unpacked why it's risky and why it can be scary. But now let's talk about why people do it. And there's one word that immediately comes to mind, and I don't know if people would use this word, but this is the reason why. Because when you think about the returns that happen in real estate and the success stories you hear, most often it is because leverage is involved. You've borrowed money to make an investment, and because you've borrowed money, you're using someone else's money to perpetrate this, the returns that you get on your capital get compounded over and over, and it starts to look amazing when you look at it on paper.
So we did an oversimplified example here, and it's on purpose. There's some extra factors we could put in. And we did a Terra Chad because, I mean, why not? This is what Daniel decided to go with the names. But the Terra Chad buys a $500,000 investment property and puts 20% down. So he's got $100,000 in this $500,000 piece of property. But here's the crazy part. This property, let's just say this all happened pre-pandemic. The property appreciated 50% over the last 5 years.
And we've seen this happen. This is not far-fetched. We've seen real estate values do this.
So you think off the cuff, you're like, man, that's a 50% rate of return over the last 5 years. No, remember, this is levered debt on the property. It gets better in this best case scenario.
Yeah, so when you think about this, Chad's initial investment, that $100,000 he put down, has increased by 250% due to the power of leverage. Remember, he borrowed money, but he gets to keep all of that appreciation. So he has a $100,000 investment he made in the profit plus a 250% gain. So he has made a huge rate of return in a very short period of time because he was able to leverage his growth.
Now, look, I do, because I know people are always looking to poke holes in things. I recognize actually this could be even bigger for Chad, and the fact that not only during this period of appreciation, he's been paying down principal on this. We didn't even take that into account, that he's paid down the mortgage over those years. But I think it's just worth noting, yes, leverage debt, when it works, is beautiful.
It's great, yeah.
As long as you have somebody who's paying your rent and making sure it all happens, it really is a magical thing.
So the growth and the opportunity is there, but another reason people like to do real estate and why people are attracted to it is because it can create income and cash flow. It's not uncommon you hear somebody say, okay, well, I'm going to buy a rental property and someone else is going to pay the mortgage, and once the mortgage is gone, I'm just going to have free cash flow flowing my way. So that is an attractive thing that can be true about real estate, but it's not always true. And then another huge benefit that we always hear about, Brian, is there are substantial tax benefits when it comes to real estate. But I worry, oftentimes, the brochure people are sold around the tax benefits may not be what plays out in practice. While it is true, there are some amazing tax benefits that can benefit certain investors or certain individuals. It's not always the way that your brother's, uncle's, best friend's neighbor told you it was going to go.
Well, look, it is. I mean, I think if your income is below a certain point, it is nice that you get to take the depreciation hit. And you get to deduct up to $25,000 of your ordinary income off your taxes. I mean, that's powerful.
It's huge. Yep.
The problem is once your income gets into six-figure level, they make you basically carry it over until you sell the property. So it's just it's good, but it's just not as good as the brochure tells you, especially once you start having the success that you probably need anyway to even be able to do real estate. The other thing I think is interesting, like cost segregation on commercial real estate and other things where you can pretty much accelerate depreciation on anything that has a life less than 15 years. You can get into multi-million-dollar deductions rather quickly. That's what's in the brochure. The part that makes it a little harder is unless you're like a real estate professional, you don't have, it's hard to have enough income to offset all of that in 1 year, because most people who are treating this as a passive investment or even have a business that they have their company in, it's hard to offset those two things together. So just understand it, but I'm not taking away it. Without a doubt, there are tremendous tax benefits, just like there are tremendous benefits with levered debt. It's just you need to understand how to do it right.
That's it. If you're going to do it right, there's some things we want you to keep in mind. Number one, wait until the time is right. Whether you're thinking about buying residential real estate or you're thinking about commercial real estate, or maybe you're even thinking about doing real estate syndications and entering into some limited partnership type deals in order to access this asset class, you want to make sure that for where you are in your financial journey, the timing is right and it makes sense and you don't jump in too early.
Yeah, I'm going to hold it up, give you all the sound effects and everything, is that I love real estate, but it needs to be a step 8 of the financial order of operations. You can go to moneyguy.com/resources, download your copy. And why do I say that? The reason I say that is because you've got to have a good financial foundation underneath you. That's steps 1 through 7, so you can weather any storms that come your way, especially if your property has a mortgage on it. If it's levered, you need to be able to weather the storms, because there might be some months that you have to make large repairs, like put a roof on it, or you have to change tenants because people, there's just lots of things that can come your way. I remember when we got into real estate, Bo, somebody we have a lot of respect for, he goes, congratulations, I'm so excited for you guys, but boys, I hope you got enough money to weather the hard times.
Yep.
And that was good advice. And I think that's something people need to understand. You got to get the timing right. And let me bring this into something we covered earlier, is that I think people have what's called recency bias, Bo. We know in the pandemic, real estate went up 50 to 60%.
Yep.
I would challenge people to think about the fact that if we know real estate typically makes 4% a year, but if it made 40 to 50 to 60% over the last, depending on which part of the country or what type of real estate it is, over the last 5 years, do you really think you can set your clock to you're going to get the same 50 to 60% in the next few few years that are coming. I think recency bias as well as reversion to the mean are real things, and you need to plan accordingly.
And the other thing you need to think about with real estate is you need to choose your location well. Just because you hear about something that might be attractive, it might not be attractive in your area. Brian, where we're both from in South Atlanta, it would not have been incredibly difficult to buy a lot of residential real estate properties. There was a strong rental market. You get tenants in there, it works. Now, where we live in a suburb of Nashville, it's very different. Home prices are very different. The community in which we live is very, very different. So the different types of real estate investment might make sense in different types of geography. So when it comes to investing in real estate, don't just buy or look for the opportunity that you think might make sense. Make sure you're really thinking through, why will this be a good purchase, good investment, good opportunity over the long term?
Yeah, and then so location to kind of sum up what your point was. But I do think this last one, and this is going to be kind of old man on the front porch, I don't know that everyone needs to invest in real estate, and definitely not start in real estate. We love real estate, but I do think it's a step 8 of the financial order of operations to do it right. And I think that even though there's a lot of TikToks out there and there's a lot of sexy sizzle to it, just make sure you understand the ins and outs to do it right, because leverage debt cuts hard and hits hard. And I just want to make sure you navigate that well.
All right, Brian. So we've talked about education is risky, but it may be worth it. And entrepreneurship is risky and it may be worth it. And real estate is risky and it may be worth it. But this next one, I get really, really excited about, because this one is risky. It is certainly risky, but in our opinion, the ROI substantiates that this is something I think most people should participate in. And it is stock market investing.
Yeah.
It is buying liquid available securities and investing over the long term so that you can have your money work harder than you do.
Now, this first one, because this is why it's risky, is that there are a lot of people that are worried that the stock market doesn't always go up. And that's true.
Sure.
I mean, 2022 was a year where the indexes were down, in some cases, over 20%.
Yep.
That's scary.
If you look at the S&P 500, again, it's just the largest 500 companies in the United States. From the year 2000 all the way now until 2023, there have been significant downturns. There was the dot-com bubble bursting in the early 2000s. There was the Great Recession of 2008, 2009. There was fourth quarter of 2018, which was a greater than 20% drawdown. There was COVID, where there was this huge drop. And then, of course, there was 2022, which is an extended period of low performance on the market. So it does not always go up. There are periods where it can be volatile. And there are periods where you open that monthly, that quarterly account statement, and it doesn't feel great. It doesn't look wonderful.
Well, and that's the risk of the S&P 500, which is the 500 largest U.S. companies. What about the risk of people who are chasing the hot dot of, think about it. If you work, there's a lot of people out there work at technology companies. So their human capital is tied in with their investment capital. And I firsthand, I can tell you, I worked with a lot of executives back when I was in Atlanta working for another firm with Lucent executives. And Lucent, a lot of you younger are like, what? What's Lucent?
What's Lucent?
Lucent would be one of those top 5 it was everything. Everybody wanted to be in Lucent. It was a high flyer in the early 2000s, and the reason you've not heard of it anymore is it's gone. It is. So anybody if you were an executive or an employee that was encouraged to invest not only your human capital but also your investment capital, when it went under, you lost it all. So there's definitely some investing traps if you concentrate or take too much risk, even with equities.
So market doesn't always go down, and it's very easy to get yourself overextended. It's very easy to get yourself in a bad situation. So if that's the case, well, why do people do it? And I think the number one reason that people like to do stock market investing is because it has been pretty consistent over time. If you look at the broad indices, we're talking about just buying the index, it's offered great returns. Since 1960, the S&P 500 has annualized just over 10% per year. That's 10% while you don't have to go out and pick individual stocks. You didn't have to look at balance sheets. You didn't have to pore over financial statements to figure out what to do. If you just bought the market itself since 1960, you would have annualized greater than 10% rate of returns. without having to have a finance degree or be some specialist figuring out what's out there.
Well, the other thing I like about and why people do this is that if you just instead of trying to beat the market, just invest in the market. You don't have to have a lot of knowledge to just go buy an index fund.
Yep.
I mean, that low barrier to entry where you can automate the process and just buy the essentially the economy and what's going on in the human experience of always innovating and ever evolving law of accelerating returns. That's easy.
Yep.
That's something that you can jump into very easy.
And I love, Brian, when you say easy, it's also, in our opinion, the easiest path to wealth. We do this annual survey of our millionaire money guy clients and family to ask, okay, what were the things that you did? What were the characteristics that you have? And one of the things we ask is, what was your path to wealth? How would you describe how you got to where you are? And what's really, really interesting is 69% of our respondents, 7 out of 10 of them from our most recent 2023 survey, said, hey, I'm just a saver and investor. I take a little bit of my earned income today and I invest it to put it to work for me so that I can have a great, big, beautiful tomorrow. It's not the entrepreneurs. It's not the senior executives. It's not the super talented virtuosos. It's the everyday millionaire next door that recognizes I can just put a little bit of my money to work and it can do amazing things over the long term without a whole lot of brain damage, without a whole lot of hard work.
So a lot of people are going to be intrigued. They're going to watch this and go want to know, how do you do it right? What's the first thing I think about, Bo?
The first thing would be, just like you said, don't chase the hot dot. So often we get caught up in, okay, well, what stock do I go buy? Or what's the top performing mutual fund? Or what's the next hottest thing? We think that rather than trying to beat the market, you should just be the market, because what matters more than timing the market is time in the market. So if you can avoid the hot dot and just do boring, plain old low-cost index fund investing, you're likely going to set yourself up for a lot of success.
Yeah, I think there's an interesting clip going around with a really popular guru talking about how easy it is to beat the market, but the reality just doesn't support that. If you look over the last 10 years, according to Spiva, 93.1% of domestic equity funds underperform the index. Guys,
that's 9 out of 10.
That's overperformance. So instead of trying to beat the market, just be the market, because that's overachievement. If you're beating over 9 out of 10 investors out there who think that they have a better mousetrap, and by the way, even if you're part of that 6.9 to 7% that do outperform, there is consistent research that shows that there is not consistency to that. I mean, I saw it on social media, somebody did a search to figure out how many funds had a performance, an overperformance for the last 20 plus years. So from a consistent basis, it was 5, not 5%, 5.
1, 2, 3,
so
4,
I mean,
5.
and all those funds had restrictions and other things. Guys, being the market is potentially a great opportunity to just capture what's going on with innovation, technology, and this growing economy that we all are surrounded with.
And right now, being the market is easier than ever. Look at low-cost index funds, whether that be something like the S&P 500 or some other index you're looking at, or maybe you just use a target retirement index fund where all you have to decide is, how much do I want to save? And then what year do I think that I'll need the money? When do I think I can retire? And you'd be amazed at just solving for that very simple piece. You can set it and forget it and build automatic wealth, which is amazing. You don't get lost in all of the things that you can get lost on, and focus on those things that are actually important.
So I know a lot of people, when they first go down this path of thinking about investing, especially in equities, they're like, man, okay, these guys have given me a lot with this. Well, I'm hearing the terms index funds. I'm even hearing index target retirement funds. But how do I know which accounts? I know there's, once you get past even how I'm going to invest, there is this a Roth account? Is this a regular retirement account? Is this after tax? Guys, that's why we talk about the financial order of operations, because this is what's going to help you. If you go to moneyguy.com/resources, it's not only going to get you into the different investment accounts, whether it's tax-free or regular retirement or even the after-tax, it's going to help you figure out the beginning stuff. Like, how do you protect yourself by having enough cash, like your highest deductible covered, as well as emergency reserves, getting that free money from your employer, as well as paying off the high-interest debt. Take advantage of the free stuff we're laying up for you. There's also a whole page. If you don't just stop at the foo. We have an entire library of free resources you can lean into to accelerate and maximize your journey to success.
Brian, you know that movie Wall Street where Gordon Gekko says, greed is good. You know what I'm talking about? We don't agree with that. That's not really our thing. But here's what we would agree with. Risk is not necessarily a bad thing. We've walked through a number of different things that can be risky, and they can be aggressive, and they can be dangerous, but if done correctly, they can be an incredibly powerful piece of your financial journey. Just because something is risky and just because something is uncertain does not necessarily mean that it's bad. But it does mean that you better know what you're doing before you get into. And what we hope we're able to do is walk you through the ways to approach those different risks in an intelligent and well thought out manner so that you can set yourself up for success.
Yeah, I mean, everything we covered with risk, reward, you have to, this is something, the big takeaway. You have to own your financial future or it will own you. I'm your host, Brian Preston, Mr. Bo Hansen, Money Guy Team, out.